So this is the first in the series of Wicked Lunches, and in that respect, we want to focus on essentially areas which are going to be attracting academic interest in the future, but combining it with practitioner content. So what we're going to do today is have a panel, and that panel is going to focus on stablecoins. The panel consists of Lory Kehoe, who's the CEO of MSX and founder and chair of Blockchain Ireland. He's also an adjunct professor at Trinity College Dublin, a Forbes contributor, and a PhD candidate. He is leading the forefront of financial innovation with a focus on blockchain, crypto, and Web3 technologies. We're also joined by Martin Dowdall, who is a senior managing associate at solicitors Sidley Austin LLP, specializing in payments and fintech regulation. He's educated at the University of Oxford with extensive experience in legal and compliance roles at firms including Allen & Overy, Alipay, and Linklaters. And finally, we're joined by Guneet, who is a PhD student focusing on digital money and privacy concerns surrounding CBDCs, central bank digital currencies. She's also the editor at Cointelegraph and an experienced professional in blockchain and financial technology. Now, before we move on to the panel, let me just briefly sort of set the playing field, so to speak. Actually, right now, transaction volumes in stablecoins are the biggest use case in crypto assets. So this is something which has changed somewhat in the evolution of crypto assets. And in fact, we're very timely with this presentation because we saw the introduction of the EU stablecoin regime on June the 30th of this year, in other words, last week, which introduced the markets in crypto assets regulation, which we call MiCA for short. Now, that regulation ensures that essentially issuers of these stablecoins need to have a MiCA license for any public offerings or traded reference assets or e-money tokens, at least within the EU. Now, that's a significant shift in the way that the regulatory framework exists for stablecoins and is really going to make a focus on the crypto asset service providers and the way that these offerings are presented. So let me just define stablecoin. Stablecoin is a type of cryptocurrency engineered to minimize price volatility by anchoring its value to a stable reference asset. Now that most commonly is a fiat currency like US dollar or euro, but it can also be commodities like gold or a diversified basket of assets. And that stability is maintained through a number of mechanisms, including things like collateralization, full or partial, algorithmic supply, and indeed intervention, stabilization, and other hybrid approaches. Obviously, to keep their stability, these collateralized stablecoins need to be backed by reserves, which are held in what we would call traditional financial assets. And that ensures that essentially what we're doing is that in the event that there's any redemption, that essentially the corresponding amount is pegged equivalent to whatever the underlying is. We have a number of terms which will probably be bandied around. We'll try to explain them as we go along. But for example, algorithmic stablecoins utilize smart contracts. So essentially, we have some quite interesting dynamics in the way that these things are constructed. Within the cryptocurrency, crypto asset world, these are actually very important from the point of view of providing a medium of exchange to more stable and traditional assets. And they also help in enabling remittances and as such are pretty central now to the world that we have come to call decentralized finance or DeFi. Now, there is a lot of things, which is why the EU introduced the regulation that come into play, like liquidity, stability, efficiency, and we will touch on those in the talk. But from a scholarly point of view, because this is UKFin plus, the scholarly rigor comes into how we go about adhering and maintaining peg stability, the transparency of the reserve, the governance structures, compliance, and regulatory structure. So what we'll now do is go with a short intro from each of the panelists for 5 minutes, and then we'll move from there into the panel session itself. So I'll invite Lory first from MSX to give an overview of stablecoins from an industry perspective.
Thank you very much, Professor Broby and Sheena, for the opportunity to join you and fellow panelists as well. So yes, Lory is my name. I am the CEO of MSX and wanted to share a few insights as to, I guess, what we are seeing from a stablecoin perspective in the UAE, in the Middle East, but also further afield as well. I think just to share a little bit of context on MSX, MSX is a regulated stablecoin company based out of Abu Dhabi, so regulated with the FSRA and in the free zone, the Abu Dhabi global markets. And so what we're doing is we're issuing a dollar-backed stablecoin, institutional focused, and that will be going live in probably late Q3, early Q4 of this year. And our focus really is to provide a mechanism for individuals to use the power and, well, companies to use the power of stablecoins for a range of use cases. So what we really are is B2B and then or B2B2C. So our customers will come on, we'll provide dollars, we'll give them stablecoins, and they'll provide them to their customers. So we think, a number of areas are very interesting to us. So it may be remittances is certainly 1, 2, gaming, I think tokenization of real world assets, 3, and aid is definitely another area, commercial property is another area. So they're kind of some of the areas that we are looking to work with our partners on to drive real world adoption of our stablecoin, which is called USX, and that is the dollar-backed stablecoin. Moving away from the unashamed sales pitch, but the kind of overview in the market is, look, I think I just checked today, the stablecoin market is currently worth 163 billion. It has grown substantially over the last, if you look back, 1 year, 3 year, 5 year period, and depending on what analyst report you're looking at, some I think are very aggressive. I was looking at it earlier. So Ripple predicts stablecoin market to be 3 trillion by 2028. That is a big jump from where we are now. I think Bernstein, a broker, said it was going to be 2.8 trillion in the next 5 years. I think other analysts have said that realistically, I think, that the stablecoin market being between maybe 500 billion and 750 billion is more realistic over that 5 year time frame. So depending on how aggressive or pessimistic you want to be, it's probably going to be somewhere in the middle along those lines. Certainly that's what we feel the case is. In terms of trends, exactly as Professor Broby said there, I think the key thing there is regulation is the key thing that has been taking place in this space. And we're going to see a lot more of it in the EU, UK, Middle East, and also just around the world. And the key thing around the regulatory piece is transparency being a key piece. So if there are, let's say, $1 billion USX in circulation, there has to be at least $1 billion in a bankruptcy remote account. And the key feature that we've been hearing a lot about is customers must be able to redeem at par within the specified timeframes as outlined by that regulator in that jurisdiction is a critical criteria. And I think another quick trend that we're also seeing is on the transparency lines is also the need for that transparency. 1 USX equals $1. And this movement away from kind of monthly attestation reports. So typically the way stablecoin companies work is that they'll work with a trusted third party. It could be a big four accounting firm where they'll produce a PDF. And in that it will be, yes, there's X amount of dollars back, to support the X amount of USX in circulation. And that's published monthly and the PDF is up on the website. That's good, but it's not real time or near real time. And so what we're seeing, I think some regulators do, and I think this is going to be a big theme over the remainder of the year, especially as we get into 2025, will be real-time transparency of the reserves. So if there are $1 billion, I want to know that that is actually the case, now and tomorrow, rather than having to wait for that monthly piece or that monthly update, as the case may be. And I think the next iteration of that again will be on-chain analysis. So we're saying that there are $1 billion, there's $1 billion USX. Why can't we use the power of blockchain technology in order to provide that attestation? And then the final piece, I think, in relation to issues that I'm sure we'll touch on, I think one of the major challenges that we'll see is in relation to reporting. So I think the Markets and Crypto Assets Regulation has brought out reporting requirements. So when different stablecoins, or one company has stablecoins in different jurisdictions, how will reporting be done when various stablecoins will move across regions and zones and countries and jurisdictions? So I think that's going to be something that there's going to be a lot more attention paid to as MiCA kicks into gear. But hopefully that's a bit of a flavor of some of the things that we're talk about with people who are far more intelligent than me. But so thank you very much, and back to you.
Excellent. Thanks for that. And I was just smiling to myself at the thought of the interest on $1 million. But let's move on now swiftly to as you mentioned, the legal side of things, legal and regulatory considerations with Martin Dowdall. Martin.
Thank you, Professor Broby. Look, I think Professor Broby and Lory have covered a lot of what I'm interested in as a lawyer who advises on crypto assets and advises people like stablecoin issuers. As Lory said, we now have MiCA. The stablecoin requirements are in force, although national competence authorities aren't all ready, as is often the case with European legislation. You have the law, but the implementation often isn't quite there. We don't actually know who's going to regulate these issuers in every jurisdiction. We don't know that there will be complete consistency in the way they think about these things. And then there's also, as Lory says, the global piece. We have regulation in the Middle East, Hong Kong, in Singapore. We have regulation hopefully coming soon in the United Kingdom on stablecoins as well. Now, there are similar principles across all of these jurisdictions. And one of the key points is the segregation of client assets, as Lory mentioned, but there will be differences. And a lot of stablecoin projects have been inherently international. They seek to solve international problems, cross-border payments, global e-commerce, trade finance. It is very difficult to comply with regulatory regimes in practice because you can write regulation, that's one thing, but trying to implement it is another thing entirely. Trying to comply with regulation in multiple jurisdictions at the same time is incredibly difficult. And it's also incredibly expensive. So I think one of the questions I have is, can the stablecoin market in the European Union and elsewhere bear the weight and the cost of this new regulation? A lot of these businesses they come from a technological background, the founders and the employees. They're not necessarily financial services compliance people, and this will be a real step change. And I think it will also fundamentally affect business models for a lot of stablecoin projects, where you are not necessarily, or at least you weren't previously, ring fencing funds and having all of that money tied up and all that liquidity and capital tied up. So can you bear the cost of that? Can you bear the cost of the compliance? How are you going to recruit the right people to look after these things? These are all difficult, if not intractable problems to solve. I think the other problem or issue, specifically when it comes to the European legal regime, is MiCA very much has its roots in a piece of legislation called MiFID II, which is designed for security-style regulation, the sort of regulation that applies to brokers and investment banks. Stablecoins are obviously primarily a payments use case. Now, the Payments Services Directive regulates payments in the European Union, not MiFID II. So you have a MiFID II style crypto regime, which is also being applied to payments use cases. And it isn't clear that's necessarily the right fit. But a lot of these concepts, like a prospectus for a stablecoin, for example, is that a good idea? That makes sense for an investment product, where you want to know the features and you want to know the risks because you are buying it as an investment. It's not obvious that that's appropriate for a stablecoin, which is bought and intended to be used as a means of payments. They're just different profiles of products. And the other piece is The Payment Services Directive regulates payment services. MiCA regulates crypto assets, and MiCA says that it is mutually exclusive with other regulatory regimes. So if you're in MiFID, you can't be in MiCA, and vice versa. One exception to that is the Payment Services Directive. So e-money tokens are funds for the purposes of payment services laws, and therefore regulated both by MiCA and PSD2. And they're very different creatures. And it'll be interesting to see how you deal with both regimes at the same time, and whether there are unintended consequences to bringing electronic money tokens within scope of both MiCA and PSD2. I don't think it's certain how that will play out yet. And I think there are also bits of ancillary regulation that maybe haven't been completely thought through. So, for example, in a payment services context, if I am a global payment service provider taking your euros and transferring those as dollars to your cousin in the United States, that FX transaction, if it's in the context of a payment, is typically unregulated. But MiCA says if you're exchanging a crypto asset, which includes an electronic money token for fiat funds or another crypto asset, then you need a specific permission to do that. So why should transferring US dollars and exchanging them for euro be less regulated than taking a US denominated stablecoin and exchanging for a euro denominated stablecoin? Again, it isn't obvious why those use cases should be treated differently, but there will be a significantly larger regulatory burden on the stablecoin use case as opposed to the fiat use case. And finally, the other question generally that comes up a lot in the context of stablecoins and crypto generally is, should there be a distinction between the services that are offered to Joe Public, my own use if I want to buy something from an online marketplace using stablecoin, and arrangements between sophisticated financial institutions, your Goldman Sachs and your JP Morgans, or big sophisticated businesses like your Amazons and your Coca-Cola? Lots of financial services regulation distinguishes between different types of customers, and the requirements will be greater or lesser depending on the sophistication of your clients effectively. MiCA doesn't do that, and there are important exclusions missing from MiCA. So for example, a payment services regime says a payment system, so a MasterCard or a CHAPS, when it's doing its functions as a payment system, that's not a regulated payment service. You don't need a license, you don't need to segregate customer funds, because a payment system, its participants are all banks and financial institutions, so those protections aren't appropriate. But MiCA doesn't do that. MiCA doesn't say if you are a payment system using stablecoin instead of fiat, then you don't need a MiCA license. There just is no equivalent exclusion. And I think that's going to cause a lot of issues potentially in the markets where unregulated entities may, it appears, require licenses that they're not used to having, and also the lack of a distinction between retail customers, consumers, and big businesses. Again, it doesn't feel appropriate. It potentially is a bit disproportionate. And the other bit that's missing, I think, from MiCA is decentralized finance. MiCA doesn't say anything about lending in crypto assets or stable coins. That's a big part of the market. It's a big part of the stablecoin use case. But what it does say is if you issue a stable coin, you can't pay the holder interest on it. So in a decentralized finance context, that could be a problem, because if you're giving somebody your stablecoin, lending it to them, and expecting a yield in return, then that looks a lot like interest. So whether that's permissible or not in the European Union remains to be seen.
Excellent. Thank you, Martin. There's a lot to chew on there in terms of sort of legal ambiguity, as well as how we go about with the adoption of stable coins going forward. Bear in mind, this forum is to sort of think of new areas of research for academia, and certainly what you said about total expense ratios being one of the big ponderables out there. We have similar issues with money market funds which charge 0.25%, and the concerns about those breaking the buck, as it's called in the business. Those are something which I think are just ripe for time series analysis and what we love to do from an academic perspective. But that said, now that's a nice lead into Carl Guneet, who is looking at these various issues from the point of view of academic insights into the future of digital money. So I pass the floor over to you, Guneet.
Yeah, thank you so much, Dr. Broby and Sheena, for the opportunity today. My name is Guneet. I am doing research into the digital currencies, specifically central bank digital currencies. Talking about the stable coins, I think that today we are at the cusp of monetary revolution, and stable coins once were a niche concept and now have become part of the academic discourse, hoping to redefine the very fabric of our financial systems. And talking about the research on stable coins, it's very limited at the moment, but still reveals very good findings that can shape the future research on stable coins. So the very first finding is that asset-backed stablecoins generally maintain price stability. They do so by holding reserves of real-world assets. As Dr. Broby already explained, that they can be fiat currencies or commodities that match the value of the issued stablecoins. A very prime example in the stablecoin field is the Tether stablecoin, which goes by the price index of USDT. So what it does is it holds reserves of US dollar as well as a combination of some short-term US treasury bonds and other short-term treasuries. And this type of collateralization ensures that the USDT remains pegged to the US dollar. And another significant finding is that stablecoin activity can influence cryptocurrency prices, for instance, Bitcoin's prices, but this effect diminishes over time. I think it's because as the market matures and becomes liquid over time, the influence of stablecoins on any cryptocurrency's price, be it Bitcoin or Ethereum or any other cryptocurrency, it tends to lessen so that stablecoins don't impact the industry on the basis of price manipulation or even as a safe haven. And also that stablecoin market capitalization is negatively correlated with the central bank interest rates. Martin has just explained on this thing, and I think this is very reasonable to understand that given that stablecoin issuers are not allowed to, offer any interest on these stablecoins, that's why they tend to negatively correlate with the central bank interest rates. So along with these findings, I think there are many areas that still remain very much unresearched or unexplored. For example, the impact of stablecoins on emerging markets and how they impact the domestic markets as well and domestic currencies, and then the adoption and use cases of stablecoins beyond the crypto markets. One area that really excites me is that how stablecoins are going to coexist with the central bank digital currencies in the future. And in terms of the innovations, there are many innovations currently ongoing in the stablecoin field. And I think the very recent example is the Tether's Alloy platform. So basically, the Tether's Alloy platform allows the stablecoin issuers to, issue the asset-backed tokens with a notable focus on over-collateralization with gold. That means that whosoever is the stablecoin issuer, they need to hold the gold reserves as a backing asset to the stablecoin. If they are, using the specific platform like Alloy to, create stablecoins or issue their specific stablecoins. And also that academic research has shown that if there is any stablecoins or any stablecoin issuer that is using, for example, partial collateralization, that leads to various issues in terms of the market stability. For example, if there are many people who wants to redeem their stable coins with respect to the underlying asset, which can be the US dollar. So if there is like a lot of demand, and if the stable coin itself is partially collateralized, that means that the stablecoin issuer might not be able to meet that sudden demand shocks. So the research shows that there needs to be optimal balance between the collateralization so that the stable coins can stand against the demand shocks and also the concerned operating cost. And talking about the various concerns with the stablecoins, there are various concerns that the literature has showed, including including the concerns around privacy. For example, the transaction data of stablecoins and the use of user identities to in order to get them a part of the stablecoin ecosystem. So the research has shown that there needs to be robust regulatory frameworks, and also the industry, academics, and the policymakers needs to work together to ensure that the stablecoins benefits are leveraged upon while mitigating the potential risks. And I think, as I've already said, that the one area that is very much, I think, relevant for the academic field as of now is to find that how stablecoins can, coexist with the CBDCs. One way that I think there is a possibility is that maybe CBDCs can, serve as the reserve asset for stablecoins, and as well as maybe they can be used as the settlement layer for the stablecoin network. And overall, I think that the stablecoins are hold a great promise to become a part of the mainstream financial system. It all needs is that the future research with the combination of industry, academics, and policymakers, so that we can develop certain regulatory frameworks and to ensure that the benefits are leveraged upon while mitigating the potential risks that are concerned with the stablecoins. Thank you.
Excellent, thank you for that. And I'm glad you also linked it to the rollout of central bank digital currencies. That's actually an area where my own centre, the Centre for Financial and Regulatory Technology, is looking at. And Dr. Karakinen, who's also a strong supporter of UKFin Plus, has just produced a paper on the sensitivity of stablecoins to interbank lending rates. So there are areas of research that we can look at, that we can measure even with the limited time series we have, which is quite exciting. I see there's starting to come questions on the Q&A. So in that respect, if anyone has questions, we'll try to incorporate those live as we go through it, and I'll answer questions as well. I'll ask the first question, which is actually to you, Guneet, as you're live. As you've mentioned, CBDCs have been used as a reserve asset and also as a settlement layer. So can you elaborate on this point for a bit of clarity, please?
Yeah, sure. Thanks for your question, Dilip. As I said, that CBDCs can serve as a reserve for stablecoins. That means that for every stablecoin issued, there's an equivalent amount of CBDC held in reserve, ensuring that the stablecoins value remains stable over the long term. And then when I say that CBDCs can be used as the settlement layer, so you can think of it like a digital highway that can be used for cheaper and faster transactions. And instead of using the traditional financial systems, the stable coins can be settled directly on the CBDC network. So that means that will help make the overall network as well as the underlying stable coin more efficient. So I hope this answers your question.
Excellent. Thank you very much. Now I'm going to throw one of the speakers' questions to one of the other speakers. So Martin raised the question, which was basically, can the stablecoin market bear the weight and cost of new regulation? So I'm going to throw that to Lory to answer, if that's okay.
Yeah, great question, and something I think about kind of wearing different hats. And in short, I think what we are seeing is that this is becoming a game which, being bigger and having deeper pockets, will definitely be advantageous as you start to begin to work through much more robust and I guess, more heavyweight style pieces of regulation, which require more resources in terms of applications. And the time it takes to get approved is therefore longer, but also in terms of ongoing supervisory activities. So startups will struggle to, unless they're extremely well funded, to last the distance by the time they get authorized, and then also to have the funds in place to have all the right people in place, which I think Martin touched on correctly, to meet the ongoing regulatory obligations. So it pains me a little to say that, because I guess how do we bring more players into this game? Obviously in a prudent way, but there should be mechanisms in place where larger institutions help to support innovation and support the ecosystem by working with regulators to create paths that make it easier for startups to join. Otherwise, what we see is the big get bigger, and we don't have the innovation that's required. So wearing kind of different hats to answer that question is the best way, I suppose, I can synopsize.
Important observation, if I may, because
of course,
Lory's completely right. Look, this is an industry that's been defined by technological innovation, and it's very often the sorts of people who are listening to this session that will come up with those new exciting ideas. But the European regulators have handed the banks a pretty big advantage in that a bank can basically do anything they like under MiCA without the need for additional authorizations. They need to make a notification, they need to do certain things, but they've got the license they need already. To go and get a license from scratch if you're a startup is a very long and very expensive process. So are we making the barriers to entry, much higher and much more expensive at the risk of stifling innovation? I think that's a real risk. Banks, also innovate and do new and exciting things, but banks are big, sophisticated organizations that often take longer to do things and maybe are a bit more risk averse. So I think that is a real concern.
Yeah, just playing devil's advocate, there are an awful lot of banks with very large balance sheets, and some of the use cases for stable coins, like the JP Morgan coin, are banking related, and so it's not all about startups. So that's, I suppose, an interesting question. Sort of, should this be a market for the established players, or should it be open to all as such? Okay, well, I don't expect an answer to that then, but I suppose it was a bit of a rhetorical question. So whilst you're Martin, on the screen, with the FCA looking at stable coins as well and so forth, they've decided to group them into different categories, and one grouping that they've decided not to focus on in the first instance is those stable coins that employ stabilization, which is a process to ensure, obviously, that there's as close a representation of the underlying as you could possibly have. That sounds to me strange, because one would want to have a stable coin that is stable. So I was just wondering if you want to sort of talk us through that element of the regulatory conundrum.
Yeah, I think the FCA is taking a more iterative approach than the European Union, which has come out with a very comprehensive, wide-ranging piece of regulation, which, may well be the best in class internationally. It's a really good piece of legislation in many ways. I think the UK is taking a more step-by-step approach. And the UK FCA has been very clear about its priorities. And it said, well, what do we think is likely to be taken up by consumers, which is primarily our interest. And when it comes to customer protection, we think it will be fiat reference stablecoins. We don't see other sorts of crypto assets being used as widely by consumers, and therefore that's our focus. And there are also other considerations. A fiat reference stablecoin is potentially a challenge to monetary policy. It might make it, more difficult to control monetary policy. So I think that's the reason the UK is focused on fiat reference stablecoins. But whether they should go further and faster is, for politicians to decide. It's not for me to opine on. And I guess we'll see how quickly we get legislation following the election, or whether there'll be a change in direction.
Excellent. Okay, well, you've touched on monetary policy there, which is also a big issue with central bank digital currencies. So I'm going to slightly move over to Guneet on this one. But one of the issues with a rollout of a central bank digital currency is what you just touched on, is should there be differential interest rates for digital money and fiat money? And if there is, how does that impact one side of the economy relative to another, and how fast the rollout of central bank digital currencies actually happens. So Guneet, do you want to field that from your expertise on CBDCs? And so the question being, you know, sort of how does CBDCs and stablecoins coexist in a world of monetary uncertainty?
So basically, my area of research is about the sentiment analysis around the CBDCs, which is I'm basically focusing on only one CBDC at a moment, which is digital pound in the UK. So I haven't, really looked at the monetary policy aspect of the CBDC, because that's a whole broad area to look at. For now, because of the many concerns around the CBDCs, so the first one being the lack of real world data. So that's why I had to, focus on one area at the moment. But from the monetary policy point of view, what I can say is that for sure that as stablecoins and CBDCs being the new forms of money, they do impact monetary policy, and the central banks, they need, because they influence the traditional financial currencies like fiat currencies as well. And this would require adjustments in monetary policy to maintain the stability as well as to control the inflation. That's what I can say from monetary policy point of view. But I apologize, that's not my area of research.
No, that's okay. Sorry, I threw that there. But financial stability is a big issue, and with if people are able to have deposits in government issued or backed assets, they are preferable in a situation where there's uncertainty in markets, and therefore you end up with the potential for dislocation in financial systems. Maybe Lory, if I can bring you in on that then, because essentially the world of CBDCs are very focused on that. But what about the sort of the more entrepreneurial end of the stablecoin market? Are they aware of these potential financial stability issues and so forth?
Yeah, look, I think so. I think from an EU perspective, in relation to CBDCs, and this was something that the head of the digital euro came out and spoke about recently. She said, did you know that 70% of retail payments in the EU take place on non-European rails? So a massive driver for the digital euro, which sounds like it is inevitable. It's not a question of if, it's when. Is the word that I come to frequently is relevance. It's taking back control in an increasingly digitized world, and a world in which technology companies, not within, based on that fact, not within the EU, are playing a material role. So how does the EU and the European Central Bank take back the reins, for want of a better phrase? So I think that is a significant driver. In another session, I also asked the question to folks at an EU level. I said, look, the question that I get asked, I'm sure we all get asked, in here is, what's the use case? What's the driver? And the response I got was, and actually, you know what, I think it's the beginning of this process, which is they want to make payments obviously cheaper, so offline and available to everybody. So the example I was given is, you're in a foreign country, you're let's say you're in Spain, you're in Portugal, and you're sitting beside somebody, and you want to share the taxi fare. And although we may use Revolut, that person from Germany or from Spain doesn't use Revolut, but you know what, they do use a digital euro, and so you're able to make that payment immediately, because it's across all the EU member states, and that begins definitely to make sense. I think also it has to be said, where the implementation phase has yet to begin, and so there's a lot of work to be done to educate all the people across the zone as to what the benefits are going to be and how it's going to be used. So just to you can imagine this is going to be a lengthy project from an IT change and implementation perspective. It's going to take many years. So perhaps they're not doing so bad on that front in very early days. But sorry, back to the question I had in terms of stablecoins. Like, for me, I don't think it's a case of stablecoins versus central bank digital currencies. We're going to see both, and I think what we're going to see a lot more of is actually are commercial or corporate entities who are starting to use stablecoins for all sorts of reasons. But cheaper, better, faster is the thing that comes to mind with stablecoins. You're able to move money. You're able to much cheaper than you are today. It is instant, so you don't have to wait for public holidays or weekends. And also, depending on the stablecoin that you use, depending on jurisdictions, I'll put all the caveats out there. There are interest-bearing stablecoins, which it could be 5% or more. Now, of course, you need to do your own research and shop around and make sure that the interest is where's that interest coming from, essentially, and that if it sounds too good to be true, it probably is. But I think what we're starting to see more of is corporate treasurers from large institutions who move money from one entity of the world to the other to explore, well, hold on a second, why can't we use stable coins to do this instead of using traditional banking payment rails, where we're able to save money, where we're able to do it instantly. And also, well, if there are companies out there like M2, a sister company of MSX, which will be offering 10% on USX on the stablecoin. Well, 10% is a significant yield, so perhaps we need to look into that.
So I think you make an important point about medium of exchange. Our modern economies require that, and money is fundamental to capitalist societies. But it can also be abused, which brings me to the next question, which is on anti-money laundering and so forth. So this is really to everyone on the panel as to will stable coins facilitate more money laundering? Can they really have anti-money laundering oversight? Is this a major concern? I don't know who wants to take that.
Well, it's something that we get asked about a lot, and we advise on anti-money laundering legislation. Look, I think it's very easy to focus on risks and problems and issues, but I think it's also important to remind ourselves of the opportunities. I mean, Lory talked about how data-rich blockchains can be and how they can solve a lot of problems and give actors in the chain access to more sophisticated real-time data. So I think stablecoins are an opportunity to mitigate the risk of AML actually happening, because it is easier to exchange more information and more real-time information that isn't really possible in traditional payment rails. So look, there's always a risk of money laundering. That's never going to go away. Criminal actors will always find ways around things. That's what they do, and they're often one step ahead. But I think blockchain and stablecoin can actually be a really powerful tool, because it can give you so much information on the payer and the payee, the status of the transaction, even the source of funds potentially. So yeah, I think there's a real opportunity there in the fight against money laundering that the technology of blockchain and crypto assets presents us with.
Yeah, and I think that's an important point. What people forget is that every digital asset has a digital footprint. And I see Professor Maggie Chen has joined the call as well. The point about crypto assets and stable coins and so forth is that they are pseudo-anonymous, not anonymous, and therefore you can analyze and you can to some extent find relationships and so forth between them, whether it's K-cluster analysis or whatever. So there's a lot that academia can bring to the table that can help address things like money laundering, and maybe we can touch on that. I see Gunnar has her hand up. Guneet.
Yeah, so Lory made a point that regarding the motivations behind CBDCs, I think that varies from jurisdiction to jurisdiction, government to government, central bank to central bank, because as we see that the Central Bank of Bahamas, their motivation was to enhance the financial inclusion. But the research shows that after they have implemented the CBDCs in the island Bahamas, so they were not able to basically achieve their goal, because they they couldn't, convince the people to use the sand dollar. The one drawback that I see here is the lack of education. People were not educated about how they should use it, or even that why they are doing it. And then talking about the Bank of England or the UK government, their motivation is that declining cash payments or fiat payments since the COVID-19. So there is a drive, that there's a shift that people are shifting towards digital payments, and that's why they are going after the CBDCs, and also that a regulated government controlled and government issued form of digital currencies. And also, as all central banks say, that they want to stabilize the financial system, their economies. That's the main motivation of Bank of England.
Excellent, thank you. So we've talked about MiCA and MiCA's interesting first piece of legislation in the stablecoin world. But there are stablecoins already existing outside of MiCA and which MiCA doesn't reach. And there are also market rumors, and I'm not going to name any names because in a public forum here, that some of those aren't truly backed one for one, and that to some extent there's potential issues. No financial innovation in history has ever been introduced without testing the markets. In other words, there's always been some form of failure, which results in greater regulation. Unfortunately, that's always been the case. What do we think about those entities, stablecoins outside of MiCA? Would anyone like to address that without getting themselves into too much trouble?
I'm happy to jump in here to start. Look, I think if we look at one of the biggest stablecoins out there, if not the biggest, which is Tether or USDT, I think it has to be said it's pretty amazing what has been achieved by USDT so far. Now, I know we need to look at it through many lenses and caveat, not supporting any illicit or illegal activity in any way or anything that breaks the law. But stepping back from an innovation, from a use case, from adoption perspective, and the size of USDT and Tether and where they are now, which is what they make up 70% of the overall stablecoin market, and it's being used all around the globe. It is pretty amazing what has been achieved. And exactly as you said, Professor, there, I think it takes one entity to break the mold, and then others follow, and regulation follows as well. So I just think it's important to call out the innovation that has taken place, which has then enabled others to, I guess, to follow along a similar but obviously a regulated path.
Yeah, it's a stunning success. It really is. Like, just look at the volumes, look at a graph, and I completely agree with all that. And I think it's important to remember that, money laundering and financial crime is not exclusive to stablecoins and crypto assets. If a younger person than me wanted to buy, illegal party supplies at Glastonbury, they're probably paying in cash. This is not, unique to stablecoins. Regulators are always fighting the last war. They're always looking back to what's gone wrong recently. And so I think a lot of the stablecoin measures in MiCA reflect things that happened, with Tether and other sort of high profile incidents. But again, I think stablecoin blockchain technology presents solutions as well as problems. Again, the ability to have richer data on the source of funds and the status of a reserve, that is something that blockchain technology can help with. So yeah, I think it's important not to lose sight of the huge success and the huge innovation, and just focus on the negatives, which are not exclusive to these technologies. And even the segregation of assets. Look, I advise payment services firms all the time on their safeguarding obligations in a fiat context, and it's something that goes wrong all the time. And it's a focus of the FCA, the segregation of clients' assets. So again, that is not just something that is a problem for stablecoin issuers. Whether you're actually holding the client funds in the amounts and in the way you are supposed to is an issue in the traditional financial sector as well.
Excellent, and thanks for that. And it's we need to keep a balance. So we need to be aware that things can be misused, as well as the innovation side of things. In terms of, we got two questions from the audience. We've got one asking, considering that the CBDCs are a new currency format backed by governments, do we know the factors that would impact consumer preferences to adopt and use it? So why would someone use a CBDC rather than a credit card, which is digital money anyway, for example?
Yeah, I can answer that. So what I see from the research perspective is that consumer preferences are mostly influenced by factors like trust, security, privacy, ease of use, and also like some incentives. For example, less transaction fee and faster transactions, basically. And I think that, yes, these factors are more or less like what impacts the usage of traditional fiat currencies as well. And also like other factors that can impact include like benefits like financial inclusion, which can make them more appealing than conventional options for some users.
Excellent. Thank you very much. We've got a very kind comment from Ewart Salins on sort of hearing from me, but more importantly, he's got a very interesting question, which is, what's the problem that stablecoins are solving?
Look, it's a great question, and I think that is a really fruitful avenue for an enterprising young PhD candidate. So to look at that, look, what are the benefits? Are there benefits to trade finance? Are there financial stability benefits? Are there benefits to consumers? That remains to be seen. Look, I think it's horses for courses, right? You know, a stable coin tends to be something that has an international element. So whether that's e-commerce and you want to buy and sell all over the world, stablecoin, you know, can be a solution to that. You don't have to necessarily pay expensive card scheme fees or expensive correspondent banking relationship fees. If you can keep it all within the stablecoin ecosystem, that can be a cheaper, more efficient way of taking payments. CBDCs tend to be inherently domestic in nature. They are limited by the scope of the relevant payment system. So they're not as good at cross-border payments because that would require interoperability between the domestic payment systems, and that takes time to put in place. But look, you know, if I knew the answer to what are the opportunities to stablecoins, I would be, you know, doing an IPO and earning billions of dollars from that. So, you know, it's over to you, I think. But I think you're right. Look, new technology doesn't necessarily solve all problems. I think that we will see the market start to specialize and provide specialist use cases for these different technologies. Cross-border payments, e-commerce seems like the obvious one to me at the moment, but that may well be a failure of my imagination. There could be all sorts of other applications that will be the future of this technology.
Excellent. And I'm glad you touched on the technology, because that's really the sort of final avenue that we need to explore. And you mentioned interoperability cross borders, and the technologists in the room are thinking cross-chain and all sorts of other solutions to that. So really a question for Lory on, obviously blockchain itself has now so many different manifestations and so forth, and you have permissioned and sort of consensus and whole things. What are your views on the adaptability of blockchain for stable coins themselves? Because obviously a CBDC would be on a hybrid platform and therefore would be and I get myself again in a lot of trouble with the technologies here, would be more stable than a stablecoin platform on a blockchain.
Sure. Look, I think what we're seeing, you know, by and large across jurisdictions is public blockchains are being used. Ethereum tends to be, or certainly I think from what I see, tends to be the first blockchain in which stablecoins are launched on, or regulated stablecoins, certainly. And I think that's also, well, for a few reasons. Ethereum is more well known to multiple different parties. So whether it be the regulator, whether it be technology companies and technology infrastructure providers as well. But what we are seeing at a, I guess, end user perspective is Ethereum can be expensive to use due to its own popularity. There can be, you know, meme phases, whether it's Pepe that drives up gas fees and people then want to use stable coins but find Ethereum too expensive. And so therefore they want to go to other public blockchains. And so I think we've seen a lot of interest in the likes of whether it be Tron or Solana, or and then moving into the non-EVM space and of Sui or Aptos, as the case may be. So I think what we're going to see is, you know, cross-chain is really important. I think Ethereum will typically be the launch pad number one, but then you'll see stablecoin providers operating on a multi-chain basis, with a keen eye on as to where are the users, what chains are they on, why are they on those chains, is it due to low cost, is it due to, you know, user incentives, as the case may be. And because I think what we're seeing there is we're seeing some specific chains be more prevalent, let's say, against specific verticals or use cases. So, for example, gaming. So I think that's the way, the lay of the land when it comes to stablecoins. Public blockchains are the way to go. Yeah.
Great. Okay. Well, I kind of expected you would say that as a representative of Blockchain Island, but in fact, thanks for that insight. There's another comment in the Q&A from Andrea, another academic, who just points out that stablecoins are also the connection between fiat and crypto, and therefore helps mitigate volatility, which I think is also an important point. So just to sort of wrap up our virtual lunch, if we could maybe just each of the panelists just quickly try to think of questions that we as academics can try to crack with our big sledgehammers, or whether everything is nice and rosy in the world of stablecoins. Who would like to go first? Guneet, you can go first, ladies first.
Yeah, thank you. So I think, of course, like I'm more interested into the coexistence of stablecoins and CBDCs, if they are being coexisting in the future, and then also assessing the various stability mechanisms of stablecoins to see like what is the ideal stablecoin mechanism that can help stabilize the stablecoins, because we see many episodes in the past that Tether and USD coin, they did depack from their value, their underlying assets value. So I think it would be interesting to see that what is the ideal mechanism for stablecoins.
Excellent. I agree. That's an interesting area. Martin, any further recommendations on where we should sort of focus our analysis?
Yeah, I think it's some of the points I touched on before, which is, what difference does it actually make in the real world? Does it actually lower the cost of remittances from developed countries to less developed countries? Does it increase e-commerce volumes of sales? Does it help merchants scale faster if they're accepting stable coins than fiat? Does it increase liquidity in financial markets if you are using stablecoin to settle transactions? Do consumers care? If so, what do they care about? What determines the decisions as to whether they adopt CBDCs or stablecoins? I think they're all really fruitful, areas for further exploration by academics.
Excellent. And in fact, that's enough for an entire centre for doctoral training, which is what academics love to hear. And then finally, Lory, back to you. What do you think that we should spend our time on from the UKFin Plus and academia in general?
Look, I think we're seeing, we've dipped our toe in the water when it comes to retail interest in stablecoins. Still very early days, still small beer, as they say, and expect that to grow over time. But I think from a research perspective, very interested at a corporate level as to, what is the level of adoption? What will it take there, for there to be adoption? And in that lies, I guess, well, what's in it for them? How is it cheaper or better, faster for the corporate? So that, for me, I think is the big thing, because retail users using stablecoins is great, but obviously the volume and value at an institutional level is mind-blowing and exponentially bigger. So I think that is an area of research, and also what we're going to see a lot more of in the coming years.
Excellent. So we're going to be gainfully employed at least the next decade. Just we'd like to hear that. I'll now hand over to Professor Maggie Chen from UKFin to just wrap up. But thank you very much, panelists. It's been really interesting, and I think that we've certainly shown that this is an area where sort of future research will really make a big difference in the direction of payments and essentially how our means of mechanism of exchange actually work in the future.
Right, thank you, Daniel. Thank you for everybody who attending the weekly lunch. And myself actually work in the area of cryptocurrency, and this is kind of so interesting. I put my hands up quite a few times, so I just can't hold onto it to not ask questions. So I'm just hoping with UKFin, in terms of facilitating the future research, we could help. And as you possibly have read on our website, we do have research funding and other resources to help you, especially to put academics and industry partners together to tackle these problems. So if anyone is interested and then continue this talk, please do get in touch. And we hope to see you in other weekly lunch in the future. Thank you, everyone.
Thank you.
You're on mute, Sheena.
Thank you all. It's been great to see you, and thank you again to Daniel, and to our panelists, Guneet, Lory, and Martin.